We're going to put this video out there to really re-emphasize what the infinite banking concept is, firstly, and then second, how it works in conjunction specifically with a cash value life insurance policy. We're going to show what a policy looks like if I just pay money into it and let it sit and grow compared to using it for loans. So firstly, what is the infinite banking concept? Well, the banking concept, to condense it as much as I can, this teaches one how to use a cash value life insurance policy as a financing tool. The word bank is in there. What this really ties into is when I look at many major US banks, the number one asset on their balance sheet is, guess what? The cash value holdings on their or in their life insurance policies. So the banking concept, IBC. Here is the best vehicle to relate it to because this is a investment or vehicle we're all familiar with. Real estate. RE. So for example, this is the concept right here. If I own a piece of property, and let's assume the appreciation is 5% per year, like clockwork. Meaning, I'm going to get 5% every single year guaranteed. It's never going to depreciate in value. There's going to be no market fluctuations. My home value goes nowhere but up. So if that value continues to go nowhere but north, and I take a mortgage, or I take a line of credit against the property, what happens? What happens mainly to my 5% appreciation? Do I only get that on the remaining equity in the home, or do I get it on my entire home value? I get it on my entire home value, regardless if that house is owned free and clear, if I own it fully, or if I have a mortgage, maybe it's 80%, 50%, whatever, I am going to take that mortgage out, and I am going to pay interest on that. Where does it go? To the lender. You're going to see how this ties into using an insurance company. Exact same thing with a line of credit. The main point is if my real estate does nothing but appreciate, I'm not going to have any lost opportunity cost. My equity will continue to build, and when that mortgage is paid off, I'm going to have access to my full home value, the equity in the full value, as if I never borrowed from it in the first place. That loan has zero impact on my money staying at work. So how's this tie to a cash value life insurance policy? So if I have a policy, and let's assume that I've got $100,000 in cash value. And let's also assume that my death benefit, the actual amount of life insurance, is $500,000. Okay? So if I decide to borrow money out, well, firstly, let's assume I'm getting a dividend of 6%. That's on my $100,000 in cash value. That is a gross dividend, by the way. So I'm going to borrow out half of it. That means I've got $50K remaining and a $50,000 loan outstanding. Here's exactly how it's going to work. I'm still going to receive dividends of 6% on the money still in cash value and the amount I have leveraged outstanding in the form of a loan. There's not going to be any lost opportunity cost. The company is going to pay me the same dividend as if I never touched it in the first place. We're going to see a chart. We're going to go through this by the numbers as well with an actual policy. Now, I took that $50K loan out. So again, they're still paying me the 6% dividend on my entire cash value as if I never touched it, but I am going to pay a 5% loan interest expense. Where does that go? To the insurance company. The interest does not go back to myself. The interest expense goes to the insurance carrier. Now, when I take the $50,000 out, the company still pays me a 6% dividend. A question we always get is, Why on earth would the insurance company do that? Or how do they do that? The answer is found within the death benefit. So if I borrow out $50,000, what the insurance company is going to hold as collateral is my death benefit. I will see a dollar for dollar reduction on the amount I pull out in the form of a loan. So if I pulled out $50,000, my death benefit value went from $5 to $450. Let's assume, to make this example as simple as possible, in 1 year, my cash value was going to grow to $106,000 at 6%. If I borrowed this $50,000 out and paid it back, let's say on day 365, what I would see is my cash value would be fully restored to exactly what it would have been as if I never touched it in the first place. There's no lost opportunity cost. I see it restored to the 106. And then in addition, I'd see my death benefit fully restored as well to the 500. So let's demonstrate this with a chart. So how policy loans work. What we have here is a 45-year-old male paying money into a policy for 5 years. We see $50,000 a year going in. Doesn't have to be $50,000. We can add a zero and make it $500,000. We can take a zero off and make it $5,000 a year. The purpose of this model is to demonstrate what the policy looks like if I pay money into the account and just let it sit and grow, and then what it looks like when I borrow and repay. What's critical about this illustration is we're not going to model paying it back with extra interest. A main point to emphasize about extra interest is what that is adding money into PUAs. I don't have to have a loan outstanding to do that. I can throw money into PUAs really anytime I want. Depends on the company and their rules and such, but I can do it with or without a policy loan. So this model here, I've got my $50K for 5 years. Break even is year 3. So that's strong, cash rich right off the bat. The death benefit is this oddball number, this $1,050,000. Where we came up with that equates to a $50,000 MEC limit. So we want to keep this bad boy tax free. Now, $50K for 5 years, let it sit and grow. That's what my values look like. What I want to highlight is, again, the policy loan. So when I start to use the account, I can take loans anytime I want, but I'm going to pull out a $200,000 loan. First thing you want to look at the death benefit from year 5 to 6 compared to over here. How much does it decrease by? $200,000. Dollar for dollar, the amount I pulled out in a policy loan. That is what the insurance company, again, is holding as collateral. Then I've got my cash value. View that as your equity or your line of credit if you want to relate it to real estate. That is going to drop when I pull money out of the account. It goes from 205 down to 53. Compare it again to the examples over here. Let's clear this out for us. Now, we took out that $200,000 loan and then began to repay it at $50K a year. I can repay it however I want. All I'm doing here is paying back the principal and interest of the loan. I'm not paying anything into extra interest. So if you tally up those repayments, what do you got? You pulled out 200, you paid back 228,975. That last payment really reflects the extra payments, or the interest. The interest rate on this example was 5%. That went to the insurance company. So if we stop here, this example would make no sense whatsoever. It means we paid interest on our own money. Where it makes sense for the consumer or a policyholder is when we look at our values when the loan's fully paid back. You've got $325 and $930 in insurance, and over here, what do you have? $325 and $930 in death benefit. your values are 100% restored to exactly what they would have been as if you never touched it in the first place. There's no lost opportunity cost there. It's the same thing when we look at the second loan. We took out a $300K loan, gradually paid it back. The only thing we want to highlight here, there's my $300K loan. There's my death benefit reduction, dollar for dollar. Repaid, we've got it highlighted in yellow for you. $509 in cash, $509 in cash. So a cash value life insurance policy, if you're at a point where you grasp the concept, which is really just borrowing and repaying, and you're trying to understand the mechanics of the policy, cash value life insurance policy, within that account, your money's always at work for you. Just like a lender, when we're leveraging real estate, the interest goes to the insurance company. However, the insurance company is going to continue to pay us compounding interest on everything, as if we never touched it in the first place. No lost opportunity cost, very liquid, it's tax-free if we do everything properly, and the net returns, view it as a safe place to position some dollars. It's going to produce somewhere between 4 to 6%, provided we're with one of the top 4 companies and we have designed it properly. Hope this helps.